But the real question is when you're in the stock market, how do you have peace in the stock market? There's two ways I see you can have peace. There might be a few more, but two major ways I see happening in the world today. One is 90% of trades aren't even humans making the trades. It's all based on algorithms. Hello, my fellow Ripplers. This is Chris Miles, your cash flow expert and anti-financial advisor. Welcome to this show that's for you, those of you that work so hard for your money, and you're now ready for your money to start working harder for you today. You want that freedom, that cash flow right now, not 30 or 40 years from now, but you want to become work optional today, where you work because you want to, not because you have to. And guys, I know it's not just for you about getting rich, although that's a great perk too, but it's about living a rich life. Because not only do you bless your family, but you're able to create a blessing and a ripple effect through the lives of others as you're blessed financially too. Thank you for allowing me to be a part of your show today, to be a part of your lives and to create that ripple effect through you as well. Hey, if you haven't done so already, go to our social media on our platforms like Facebook, Instagram, TikTok. Look up @MoneyRipples. Follow us for good video shorts as well as additional ways that we can serve you right now. Okay, guys, so I want to bring up something that I know is on a lot of your minds right now. And maybe this is especially for you, where you're looking at the stock market and you're seeing the ups and the downs. And overall, it's still up, but there's all this uncertainty and talk about, is there a recession or not? By the way, tune in next week. We're actually going to talk about what actually causes a recession. What's the real story behind a recession? How do you really know? We'll talk about that next week. But and in this case, I want to talk about the stock market specifically because the stock market works independently of recessions. You can actually have a booming period in the economy, yet still watch stocks go down. Vice versa, you could have a recession and stocks could go up. So how do you know when's a good time to be in the stock market, when's a good time to be out? So guys, I'm going to do a couple things for you, right? One, I'm actually going to show you this video clip from Dave Ramsey because this guy had a very common concern, maybe just like you, 41-year-old guy wondering if he should start bailing out of the stock market. Notice what Dave Ramsey says, and then let's talk about reality from a real perspective here, not just some talking head that gets paid a lot of money to just say whatever comes out of his butt. Okay, so let's dig into that right now.
Planning to work until 60 some years old to retire. And so I have retirement and I have investments that aren't retirement. And so I'm investing heavy right now. And I feel like it's so overinflated at the moment. And being that I'm not completely out,
That's because it is overinflated. Keep going, buddy. By the way, notice he said he's not necessarily always trying to plan to retire till 60. I like him already. He sounds like our kind of guy on this show.
significant money in right now. Would it be wise to just collect 5% in the money market and wait for a correction? I know you're more of a slow and steady, just keep putting it in every week, but it just seems a little crazy right now.
Yeah. Well, generally speaking, the reason it seems a little crazy is it's the first time you have stood on top of that mountain. If you'd stood on top of that mountain several different times, it wouldn't feel as crazy. And so it's an emotion that says, I've never been here before. And human nature, I think there's something about, there's a black side of human nature, a dark side of human nature that says, oh, it can't stay good.
Actually, there is, and I'm going to show that. Also, here's another side note too, guys. When he's talking about this, notice he's saying he's on top of a mountain. He's never been there before. This guy's 41 years old. Now, I will give him the fact that for the last 15 years, the market has been predominantly up. So maybe this is the first time since he would have been 26 years old when the market started hitting a low and coming back up. But what if he was already putting money in a 401k before this? What if he saw the Great Recession? What if he saw some of these things and wondered, what if this is not it? I've been through multiple ups and downs. Dave Ramsey, he's a few years older than me. He's about, I believe, 13 years older than I am. But that being said, I've seen ups and downs too. I've stood on some mountaintops and watched them crumble too. So I think it's fascinating. It's kind of some good advice because you don't want to bail out just because you haven't seen highs and lows. At the same time, you got to be a little bit wary of this advice.
If you
too.
had called me 5 years ago and I said, oh yeah, we're getting ready to have a correction, you would have missed out on a 90% rate of return. You're in the last 5 years in the S&P 500, your money has doubled.
Almost double. Yes, that's true. Here's another side point, guys, too, that goes with this. When he said 5 years ago that if it's going to start going down, the market actually was starting to go down. What stopped it from going down? Freaking money printing is what stopped it. The fact that we had artificial inflation created by the feds printing more money, especially with 2020, we were actually moving into a recession. Everything was pointing towards a recession in 2018 to 2019, and the stock market was starting to soften a little bit. And then, bam, right after 2020, which was supposed to be what we thought would be kind of the black swan event, right? That would kick off that market crash finally. Guess what? The opposite happened, because it did crash for a few days, few weeks, and then it came right back up roaring because all this money was being pumped in the economy. Again, next week I'm going to talk more about that and why that kind of delayed the recession longer.
Well, I mean, it goes up, it goes down. You know, in 22, the market was down overall. In 23, it was up 27%. It's up 18% already this year. But that doesn't mean that it has to correct, because there's actual income and assets backing the companies that create the stock price. You don't price Home Depot stock based on a wish, a dream, and a prayer. Home Depot actually makes money, and they own stuff. You don't.
True and not true. I'll talk about that later.
Price Apple stock based on a wish and a prayer. They actually make stuff and make a profit, and you can use those numbers to determine the value of the company and therefore the value of the stock. And that's where this is coming from. It's coming from the prosperity of these companies, George.
And what's amazing, Steve, if you actually look at the data, if you go look at right now the S&P 500 returns, you know, the last major dip was COVID. And guess what? March 2020 was the dip. It came back in July, back to record highs. And so you got to just...
That wasn't a real dip, guys. 2020 was a fluke. It was not a real dip. It was a scare, just like 9/11 was, and it popped right back up.
You know, the old saying, it's true. It's not about timing the market. It's about time in the market. And the best investors out there are the average ones who just let it ride.
Yeah, so please don't try to time the market is the moral of this story, and that's what you were asking about. So, and you know, it's one of the reasons I tell folks to be in with a SmartVestor Pro, because all the data tells us that someone who has a good broker in their corner, not somebody who's a shyster, but somebody who's calm and data-based, and they'll teach you, talk you off the ledge, you know, talk Steve off the ledge, they tend to keep you in the market. They tend to say, don't get out, don't get out, don't get out. They don't call you up and go, I'll be scared. No, don't get out, don't get out, don't get out. Set it and forget it, set it and forget it. Time in the market's more than timing of the market. Well, that's a great phrase. I love that phrase. So all the data says, for that reason, if no other reason, a good broker in your corner, a good SmartVestor Pro in your corner, makes you money, because they keep you from the as Churchill talked about his depression, he called it the black dog, right? The black dog inside of every one of us is telling you, you know, get out of the market, it's going to crash. Get out of the market, it's going to correct. And there's nothing that indicates that.
Right. So I'm going to stop it right there, because, you know, there's good stuff being taught here. There's truth mixed with a little bit of fiction. Okay. Now, overall, what they're saying is, of course, like, don't buy into clickbait, don't buy into the media. I totally agree, right? That is truth. Like, you do not want to do that. The problem is, what they're saying is, like, for example, when Dave's saying, find a good broker, and a good broker is going to tell you to stay in, right? You're going to stay into this thing, whether it goes up or down, you're going to stay in this. That's what a good broker will tell you to do. Okay, well, that good broker, why does he tell you to always stay in? Set it and forget it. He'd use those exact words. How many times have I said that on the show about that's the thing that brokers always say? Why do the brokers say set it, forget it? Because that's what they're trained to teach based on what the institutions do. Having been a financial advisor, remember, I was a guy that in the 2000s, I was a financial advisor and I was a stock trader who was also teaching people how to trade stocks and options. Guys, I had bought into the stock market hook, line, and sinker. And that's why I'm going to show you some things here that this is why I don't put money in the market right now. You do whatever you want to do, right? Even if you're in it, congratulations. You actually beat the odds. You guessed correctly. And I repeat the word guess. right? You guessed it correctly. That's it. It was not formulaic by any way, shape, or form what happened the last 4 years, especially. In fact, if anything, it was actually crap. It's all an illusion, right? But when he says, of course, your broker's telling you to keep it in there. Why does the broker want you to keep it in there? Why does the financial companies tell you to keep it in there too? Because that's how they make their money. Assets under management. The more money you keep with them, the more they make on you. This is why we have so many people hiring us right now, because they're saying, wait a minute, I'm paying a broker 1% or more per year on my money every year, whether he makes me money or not. Or she, if there's obviously some she brokers too, but he or she makes me money or not, I'm always paying the money, and they do jack squat. Sometimes I might say they'll rebalance my portfolio, whoop-de freaking do. They don't even know what they're doing. They'll have you take a questionnaire to see how much risk you're willing to take, right? But the real question is when you're in the stock market, how do you have peace in the stock market? There's two ways I see you can have peace. There might be a few more, but two major ways I see happening in the world today. One is you set it and forget it, meaning you ignore it. You just turn your blind eye to it, and that's it. Now, the good news is you can sleep at night. The bad news is that when it finally comes time to use your money, you may not be able to sleep for any more nights after that, right? Because if it does not work, you can't go. You could try to blame your financial advisor, but they don't know what's going on in the market. They'll blame everything else but themselves. And the truth is, you don't have them to blame. You only have yourself to blame, because you're the one that put their money with them and just turned a blind eye. When has turning a blind eye to anything in life ever worked out well for you? Now, you might say, well, ignore the news. Okay, there's some good things to that. I'll give you that much. And this is partly news. But when it comes to stewardship, your money is a stewardship, right? You might say, well, stewardship, when is turning a blind eye ever a good thing? If I turn a blind eye to my marriage, what do you think is going to happen? I'm not going to be married anymore. I turn a blind eye to my kids. They're not going to want to be around me anymore either. I turn a blind eye to my health. My health won't be around anymore. If I turn a blind eye to my money, it won't be there either. That is exactly how so many people, so many Americans especially, get to that point of retirement and say it's not enough. Just like my dad said years ago, even though he was 61 years old, and he said, Chris, what do I do? And I said, I don't know. You did everything right. You're debt free. You've stuffed money in that 401k, and yet you can only live for about 5 or 6 years on the money you have here, and then you go broke. That's it. You've saved up for decades to live on 5 or 6 years. What a crock of crap, right? That's exactly it. Now, notice that Dave says, well, it's just data. Okay, I would love to know what data he looks at, because half the data he says is false, right? When he says the market's done 12% return, bull, it hasn't. When he says you can pull out 8%, even George Camel disagreed and said 3%, and yet he had to come back and renege against it because Dave's his freaking boss. So, of course, he chickens out on that. Instead of standing up for his guns, they look at the data. So even when you hear data come out of his mouth, it's not data. Okay, guys? Yes, the market's always gone up, but at what cost to you? Let me show you history and let you decide on that, because that's the one thing they don't show you. They talk about it all the time. They never show you anything. Let's show you this thing once and for all so you actually know what we're talking about here. So stock market, again, if you want to have peace, turn a blind eye to it, or secondly, you become a wise steward of your money. And yes, you could still have money in the stock market and be a wise steward, but you might start to realize, ooh, there could be some issues here if I'm not careful. All right, I am showing you the S&P 500 from the 1920s all the way till now. Now you can see the 1920s. I'll try to pull this chart over here a little bit. You can see it only shows you starting the S&P around, I think it's the beginning of the year 2028, 1928. This is almost 100 years of data, as they like to say, right? Now, notice we have the roaring 20s, of course, that continued on. 1929 was awesome. And then boom, right about to 1930, we start seeing at the end of 1929, Black Friday, right? Or Black Tuesday, whatever it was. And then it crashes. But then notice it comes back up short term. It's like this temporary crash. 1930 starts to come back up again. It's like, ooh, look at this. By the way, you can see over the right-hand side, there's a little black bar. You see 1864, 18.64. That is what the S&P is trading at, right? Now, notice it goes up and then starts to kind of go down and then bam, then it starts tanking. Now, it doesn't look like much, right? Because it came all the way down to here. That's showing. Oh, sorry. Don't look at that number. Sorry. Take that back, guys. So notice at the upper left-hand side, I was looking at where my cursor was. Upper left-hand side, you'll see like it says OHLC. C is close, so that's the number, right? So you'll see here, it even gets up to like 24. Then it starts, that's after it went down. By the way, you can see it even hit a low of like 17. That's after it hit a high around 31. So it went from 31 and then just in a matter of months down to 17. Almost reminds me kind of like COVID, doesn't it? Then you know what? It's fine because after after that period of time of end of 1929, it starts to come back. This is what happens every time. There's always like this quick drop and that seems to come back. And then bam, so it comes back up almost to 25 and then boom, drops down 16, 13. Notice it goes all the way down to, let's see, right there about 1930, almost 33, 32. We get down around 6, guys, 6. It was up at around 31 down to 6. That's like an 80% loss. That's why they say the depression at the bottom was an 80% loss. Did it come back? Yes, it did. But what did it take to get back to 31? Here, guys, keep watching the numbers. Oh, there it is. We just passed it. 31 was about right about there, right? That's about 30. Hit 31, 32 right there. September 1954. So remember, after the Depression, the Great Depression, if you had $100 and you invested at the height of it, you would have had to wait another 25 years to get your money back to where it was. You don't think with inflation that wasn't a problem? No, you're not even there yet, right? Now, if inflation, everything else, and of course you're chasing after inflation as the years go on, you probably have to get closer to about, the 1960s, probably at least 30 years to say, yay, I broke even on my money. This is why, of like my grandparents' generation, the people that were alive in the Great Depression did not trust the stock market. They're like, no, it's fine. Yeah, you can put some money in this, but you're just gambling in stocks. It was a gamble. It's amazing how we made it with the good marketing from different institutions, including the United States government, who wants you to take control of your own money because they know that Social Security is going broke. They got to tell you to do your own savings for once, right? They're telling you to do that. Now, look at this. Now we see that, of course, from the 50s, boom, just awesome, right? Great times. Now, even those our generation of parents, they still looked at it as being a gamble, right? Some of them might put money in, but here's what happens here. Notice when we get to like the 60s and into the almost in the 70s here. 60s top out around 91. Then it finally gets up to about 100 there, right there. Late 60s, we get up to 100. So finally now we're about a little over 3 times what it was in 1929. It took, 40 years to get there to do triple, right? That's horrible, by the way. Tripling your money in 40 years is not good. But notice it goes down. And notice that these highs, they kind of hit new highs, but they really don't get anywhere. And you'll see it comes crashing down right there in 1974. Why does it come crashing from 73 to 74? We're taking off the gold standard. And then it starts bouncing along that line, comes back slowly. But notice, again, that height of, really that height of 1973, at about 116, it didn't get back to that again until about 1980, right? So it took 7 years to, again, get back to its previous high, to make 0%. 7 years. This is not an uncommon thing, guys. When it goes down fast, and it takes a long time to recover. That's typical. Down fast, long time to recover. Now, barring the exception of boom times when it doesn't come down, notice I have this other line right here. See this other line going up along the way? This is what in stock trading we call a trend line, right? So when I taught people how to trade stocks and options, even when I traded stocks myself, you would draw these trend lines to see kind of where's it bounce off of. We know that long-term, the stock market always goes up. This is the long-term trend line. And where you draw it from is key, right? I always wait till after it breaks a pattern before you start drawing it. And notice over time, this trend line stays pretty true to itself, doesn't it? As I'm moving into the 2000s, look at that line, going nice and easy, right? Now, it did that all through the 80s. And then, of course, the roaring 90s happened. You can see it goes way above this is the trend line here. Now, I created a new trend line just to show you there was another trend line. This is from the 80s, because again, everything was booming. But notice that all of a sudden the trend line became the resistance. It wasn't only the support it bounced off of, then it was the ceiling it bounced down from. And that's what you saw there after Y2K. It kind of climbed up and then boom, Great Recession, then went down to long-term trend line in 2000, really 2009 was the bottom, March of 2009. This is what everybody compares to when they look at the last 15 years to say, well, my goodness, the last 15 years has been amazing. The market's gone up so much. You're right, because from that trend line bounce, it has gone up, up, and away. Notice the different lines here. Now I even put the resistance lines on the top of this trend. So you can see that we're kind of near the top of this as well. And then there's another bottom support, like the shorter term trend line that's been going along. This means, guys, if it pulls back, and you see the S&P go down to 4,500, give or take, and it goes below that, or more, because you can see that line gives up over time, even in 2026, if it breaks below 5,000, it could easily break down towards this next trend line. Notice where, if we go to today, right? There it is today. Put my think cursor right on that line. The S&P long term should only be about 1,800 points, not 5,400, 1,800. Now, even if I went to 2026, right? Maybe it took some time to go there, right? Still 2026, less than 2,000. Guys, we are way over it. The last time we saw way over, right there, the 90s, the roaring 90s, after the internet boom, Y2K, it started to come down towards it, but it didn't come down all the way. It bounced up and then bam, again. Notice, even with 2020, that tiny little dip, it just dipped briefly. So when they say, oh, well, the 2020 was a little recession, it only lasted for 3 months. That was not a real recession, guys. The problem is we were kind of already in a recession. We were already moving into that, but no one wanted to believe it. No one, not to mention when the feds artificially print more money, the government's in bed with the feds that way, right? I didn't mean to make that rhyme. They got the beds with the feds. When they do it that way, then of course they pump more money. More money has to go somewhere. Where do they put it? They threw it into the different markets. That also meant in other people's hands. We put more money in people's hands. They then spend that money, goes to those companies. Yes, the companies were having profits like crazy, but we're having more and more news coming out of companies closing their doors. Lots of retail stores are closing their doors right now, going bankrupt, filing for bankruptcy as we speak. Many restaurants are filing for bankruptcy as we speak. Hotels are suffering. Airlines have been suffering. Everybody has been suffering because the American consumer cannot afford to spend. This is where the greater the party, the greater the hangover. That's what happened in the 90s when we had that and then Y2K came down. Now, it looks like a little blip, right? But that was still from March of 2000 when we kind of hit a high. And even then, it stayed up high until August of 2000. Then it started to come down. By the way, I mentioned about, you might have said, wait, he just said that after 9/11, things went up. It did. If I zoom in here, you can actually see it. There's that little dip, went down around 1,000. But then by the end of the year, it was up over 1148. So guys, it had gained about a 15% jump after 9/11 because people banded together. But of course, in 2002, the biggest drop, that was about a 22% drop in 1 year. That big drop happened. Why? Because all the fraud happening. They started to realize that all the so-called profits that companies were reporting were actually false. They were actually being lied to. That's why Arthur Andersen got in so much legal trouble. That's why we had Enron and WorldCom failing at that time. I remember people having Enron stock freaking out because they were like, I was a millionaire and now I have nothing. I have no money at all because I put all my money, all my retirement in that place. I started as a financial advisor right about the time that Enron failed. Needless to say, when I talked to some of those Enron employees, they were not happy. They didn't trust the stock market after that. I wonder why, because they're seeing reality. So what I'm saying here is, guys, is yes, this could still continue to go up potentially, especially if they print more money. But if they stop doing that, or if something happens that restricts it, and I'll talk about that next week in my thing when I talk about recession, that's where we can see a drop. So the question you have to ask yourself is, okay, we are kind of near those all-time highs again, which the stock market always does. But how many all-time highs do you hit before it finally comes back into balance to that long-term trend line? At some point, guys, it seems like, it's going to hit it. Now here, it went from that last bounce was right around 1982, right? And it started bouncing off that trend line. Didn't even touch it till about 2009. So, well, looking at that, that's 27 years. Well, we're only about 15 years out. Could it go longer? Maybe. I think it all depends upon what happens from here. But remember, even during that time when it boomed, there were still times when there was a bust, right? There's still times. Think about it, when your money, you had it in August of 2000, right here. I'll go back to that high. That's not quite the highest high. March a little higher. We go back to August, right there. It hit a high of 1525. The next time it got to that, it got there right about 2007, hit that same high, bounced down again. We call that resistance. There was an actual line going straight across there as a double top. Boom. And then, of course, it starts going back up. When we hit, 1500 again, I always say it's 2013. What was it? 2013. But unfortunately, because of fees, it took people usually at least another year or two to 14 or 15 to finally have their money back. Remember, the height of the money you had at 2000. What if you did what that guy did? What if this is the height right now? We don't know, right? But what if it is? If he had taken that money and put it into a 5% money market, he would have had a lot more money than anyone, even by 2015. that had their money in the market from 2000 to 2015, he would have won. Anybody in a CD, this is why it comes down to this one key point, guys. This key point is this, is that when you invest, right, when you're in the market, you don't know what's happening. 90% of trades aren't even humans making the trades. It's all based on algorithms. Guys, this is the first time in history we've actually done this. That means, because he says, don't listen to the media and the clickbait. Well, guess what? The AI stuff, all those automations are trolling, looking around for that clickbait. They're looking for news items. They're looking for things to give it a reason to buy or sell stocks. What did they sell? What if they all of a sudden sell short? We've seen that, big institutions that try to sell short on something can drive a stock down even when there's no reason for it to go down, and drive stocks up when there's no reason to go up. That's a scary place to be. That is a gamble where you have zero control. And how can you truly have peace of mind when you have no control? You can't. You logically cannot do it. You have to emotionally lie to yourself to have safety and peace in the stock market. Now, you could do different things to try to help diversify, right? But let's be honest. When you do that, you make cruddy returns. You still are taking high risk, and the market could still go down. Even with all those things you diversify into, all of them could go down at the same time. Even bonds and stocks can go down at the same time. Happened in 2022, happened in the last recession too. It happens at least every few cycles, right? Or at least every cycle you see both stocks and bonds break down, and they lose money, right? Now bonds might go up and stocks could go down. They could do inverse too. That happens, right? But again, do you understand how that works? Can you make sure that you're always going to make money? Where are you going to keep your money safe? What are you going to do? Guys, even with all my trading experience and seeing these charts, because I see this and because I see where it is, I think this is a horrible opportunity to buy. When would I buy in the stock market? I would buy after everybody says sell, especially when everybody does say sell. That's the time to buy. No one, okay, I shouldn't say no one. Very few people are saying sell right now. They're all saying, hold on, it's going up. Those doomsdayers, they've been saying it's wrong, like Dave said, right? Oh, they said wrong. What have you got on 2019? Well, I did. I actually made sure I wasn't in 2019, and I still made a lot of money in real estate, more than I would have made in the stock market. I've shown that to many people. If you watch my master classes on this same channel, if you go to the live section under this Money Ripples podcast YouTube channel, I've actually done webinars on passive income, and I've shown how my properties have beat the stock market by far. And these are properties that, again, can go up and down in value too. Like I have issues where there's repairs need to be made. And even despite all of that, with all the profits, everything I made, I've destroyed what I would have made in the stock market in the last really 6+ years. Even though the market doubled, I still did better. Do I regret getting on the market? No. The best time would have been getting in the market in 2019 when everybody hated on the market. No one emotionally is hating on the market right now. We are not in a cycle where it's a good time to buy. It's not in a cycle where it's oversold. You want to get in. If you really truly believe buy low, sell high, if you really believe go in the grocery store, you should buy it at the lower price, not the higher price, if you had all things being equal. If you really believe that, then why are you buying at the highest price possible when you know there's a sale coming up? The problem is you just don't know when the sale is. It could be next week, it could be next month, it could be next year. And you might say, well, should I always delay it? No. But could you store your money in better places? Yes. And I'm just here to predict, again, I think the market will correct once more. 1 year correction out of 15 is bad, guys. It's bad. So that's not enough I'm going to say on this topic. I want to save more for the recession. How do you know when there's a recession? How do you create a boom time in the economy? I'll actually kind of do an economics lesson that's a lot simpler than what you got from your stupid, boring finance or economics teacher. We'll talk about that next week, guys. But in the meantime, if you have questions, you can always reach out to us at moneyripples.com. Make it a wonderful, prosperous week.